Welcome to the debate. And just to get this out of the way right off the bat, this is not financial advice. We are purely exploring the ideas, the theories, and the wild reality of what is happening in the markets right now.
Right, exactly. Do your own research, folks.
So it is February 2026. And if you have been paying attention to the financial headlines this week, especially coming out of this Strategy World 2026 conference, you know the ground has completely shifted beneath our feet. We are not talking about the origins of Bitcoin anymore, where it was just this decentralized peer-to-peer medium of exchange created after the 2008 crash to, stick it to the banks.
Yeah, the days of trying to buy a cup of coffee with it are long gone.
Exactly. The era of crypto as a casino for day traders buying dog-themed coins on their phones is effectively over. We are now witnessing the dawn of Bitcoin for corporations, the rise of national strategic reserves, and a total reevaluation of what companies actually hold on their balance sheets. So the question on the table today is simple, but the implications are massive. Is this maturation, or is this just mania disguised as institutional strategy? Is Bitcoin finally evolving into digital capital, like the ultimate strategic reserve for the Fortune 500 and sovereign nations?
Or, and this is where I come in, are we just watching a massive, heavily financialized, energy-intensive asset class get propped up by circular economics? Look, I am here to be the skunk at the garden party today. I take the position that while the underlying code is resilient, the economic models being built on top of it right now, specifically this reflexive flywheel everyone is cheering for, are introducing systemic risks that are being totally ignored. We are building a high-tech house of cards that is one regulatory crackdown or, frankly, one quantum leap away from falling down.
And I am here to argue the exact opposite. I believe we are upgrading the world's operating system. We are moving from a fragile, debt-based fiat system to absolute digital property. To understand where we are in 2026, you really have to look at Ray Dalio's concept of the changing world order. Dalio observes this pattern over 500 years of history, right? Empires fail when the government accumulates too much debt. And when they have too much debt, what do?
They print money.
They print money, they debase the currency. It happens every single time. We are in a state of fiscal dominance right now where the printing press is the only tool left. So in that environment, you don't want currency, you want property, you want a storage of value. Bitcoin is effectively a block of Manhattan real estate, but dematerialized. It is an escape hatch. And the fact that the United States government signed the Strategic Bitcoin Reserve Executive Order, followed by states like Texas and Pennsylvania adopting it, proves we have entered the sovereign phase.
Okay, let's cap the brakes on the Apex asset, digital Manhattan rhetoric for just a second, because even the biggest bulls at that conference admitted that while humanity gets a B- in engineering for creating Bitcoin, we get a D- in economics.
I mean, I wouldn't say a D-.
No, it really is a D-. You call it digital property, but that word property is doing a monumental amount of heavy lifting. In the real world, property laws are enforceable. If someone squats on my land, the state creates friction to remove them. If a hacker drains a corporate wallet, that property evaporates into the ether. There is no recourse. But my bigger issue isn't even the code. It is the financialization. We are seeing companies turn this into what looks like gussied-up gold buggery. They are taking a highly volatile asset, which, let's remind the listeners, just dropped 45% from its all-time high relatively recently, and they are wrapping it in complex credit products.
But volatility is not risk. That is a fundamental misunderstanding of the asset.
Tried telling a corporate risk manager that a 45% drawdown isn't a risk. They want stability. When you take an asset that volatile and use it to issue debt, it feels less like a solution to inflation and more like a leveraged bet on perpetual growth. You're telling me this is Granite, but Granite doesn't lose half its value in a bad quarter.
Look, if you want a story to tell your friends at the pub to impress them, explain the difference between volatility and risk like this. Volatility is the turbulence you experience on a rocket ship leaving the atmosphere. Risk is staying on the dying planet. The economists always get this wrong because they want Bitcoin to be a medium of exchange. They want it to be high-frequency money like Visa or cash. But Bitcoin is low-frequency money. You don't buy a beer with a skyscraper.
You hold the skyscraper for 50 years, it preserves your purchasing power, and you borrow against it to buy the beer.
But borrowing against it is exactly where the systemic threat lies. Let's talk about Michael Saylor and what he has done with his company strategy. Because this is the elephant in the room.
It's the most brilliant corporate playbook of the century.
Well, let's explain it for the mass crowd so they understand what is actually happening. Saylor took a sleepy software company and turned it into a massive Bitcoin holding company. How did he do it? He issued convertible debt, he borrowed billions of dollars from traditional finance to buy Bitcoin, and now, in 2026, we have this new STRC product, this stretch product.
Right, digital credit.
Digital credit, exactly. Where they offer, what, an 11% yield to credit investors, and they strip out the volatility.
Exactly. It's intelligent leverage. You have the credit investors in first class. They get a smooth ride, a guaranteed 11% yield, and they don't have to deal with the accounting nightmare of holding a volatile asset. Then you have the equity holders of the company. They are strapped to the engines. They absorb the volatility. If Bitcoin goes up, they get the amplified returns. If it drops, they take the hit. Saylor isn't worried about a sharp price drop because his debt is long-term. He doesn't get margin called. It is a PhD in hodling.
A PhD in hodling or a master class in reflexivity. Let's explain reflexivity to the audience because it is a complex economic term, but it's vital here. Reflexivity is a feedback loop. The company issues debt to buy Bitcoin. That massive institutional buying pressure makes the price of Bitcoin go up. Because the price goes up, the company's balance sheet looks stronger, which allows them to issue more debt to buy more Bitcoin.
And it sucks the monetary energy out of the dying fiat system.
But it works in reverse. It mimics the very fiat money printing behavior that you just criticized. It's hypothecation. It's like taking out a mortgage on your house to buy a second house and then using the second house to buy a third. If the underlying asset Bitcoin drops 70%, which it has historically done, that equity premium evaporates. The credit investors might think they are safe, but suddenly that 11% yield looks like distressed debt. You are relying on a greater fool to keep buying.
Printing is infinite. The total supply of Bitcoin is 21 million forever. It is mathematically secured. And we are seeing this globally. It's not just Saylor. Look at the ordinary Japanese view right now. Japan has an aging demographic, a collapsing yen, and they are watching their purchasing power melt like an ice cube in the sun. So you have Metaplanet in Japan copying the Saylor playbook.
Right, Metaplanet?
They are issuing yen debt, which is incredibly cheap, to buy Bitcoin. They are capturing the spread between a dying currency and an appreciating digital property. It is brilliant. If you're a Japanese citizen, you're looking at this as a lifeboat.
I look at Metaplanet and I see a symptom of desperation, not a sovereign strategy. Japan's credit market is massive. The global credit market is, what, $300 trillion? Bitcoin is still a drop in the bucket. And this brings up a huge blind spot in the bull thesis, external threats. You say it's mathematically secured forever. Let's talk about the quantum threat.
The quantum computing FUD. We always come back to this.
It is not FUD. We are in 2026. Artificial intelligence and computing power are accelerating at a terrifying rate. If a state actor, say the NSA or China, develops a quantum computer capable of cracking the elliptic curve cryptography that secures Bitcoin, your immortal digital granite turns into digital dust in milliseconds. The entire network gets exposed.
Okay, but you are treating the software like it's a static rock. It's not. It is a living defensive organism. Have you looked at BIP360?
The Bitcoin Improvement Proposal.
Yes, BIP360. The developers have already gamed this out. If quantum supremacy becomes an imminent threat to the encryption, the network undergoes a soft fork. They upgrade the cryptography to a quantum-resistant signature scheme. It adapts. The idea that a quantum computer is just going to sneak up and instantly destroy a trillion-dollar network ignores the reality of open-source development.
Upgrades require consensus, and the Bitcoin network is notoriously slow at reaching consensus. A quantum attack happens instantly. But even if we assume the code survives, let's look at the physical reality, energy. We're in an energy war right now. Look at NVIDIA, look at ChatGPT, and these massive AI reasoning models. They require exorbitant amounts of power. AI is actually productive. It cures diseases, it optimizes logistics, it writes code. Bitcoin mining is literally just computers guessing random alphanumeric strings to win a lottery. In a world of energy scarcity, why would any government let Bitcoiners compete with AI for the power grid?
Because they are not competing for the same electrons. This is the most misunderstood environmental issue of our time. AI data centers require extreme low latency. They need to be built near major metropolitan areas, plugged into the primary grid. Bitcoin miners don't care about latency. You can put a mining rig in a shipping container on top of a capped oil well in North Dakota and run it off stranded methane gas that would otherwise be flared into the atmosphere.
But they are still drawing massive power.
They are monetizing stranded energy. Or look at remote hydro dams in places like Bhutan or Africa. They generate power during the wet season that nobody is there to buy. Bitcoin miners buy that excess power, which provides the revenue needed to maintain and upgrade the grid. Bitcoin is a load balancer. It doesn't compete with AI. It subsidizes the infrastructure that AI will eventually need.
That is a wonderful narrative for for a debate show. But in practice, we are seeing miners buying up power plants in Pennsylvania that absolutely could serve the local grid. And geopolitically, the energy usage makes it a target. Ray Dalio also warns that when a new form of money threatens the sovereign, the empire fights back. You mentioned the U.S. Strategic Reserve, the Trump executive order, and states adopting it. That's great game theory, but what happens if the US or China decides that this parallel financial system undermines their ability to control monetary policy? They don't have to break the code, they just make it illegal to interface with the banking system.
They already tried that, and it failed. The game theory of adoption is a prisoner's dilemma, and we have already crossed the Rubicon. El Salvador bet the farm years ago, and they are thriving. Now you have the UAE, you have sovereign wealth funds, and you have the U.S. Strategic Reserve. If the United States holds Bitcoin as a strategic asset, it creates a psychological and geopolitical floor. If China tries to ban it, they are just giving up their slice of digital Manhattan to the West. The game theory dictates that you must adopt it to protect your sovereignty.
Or you are just participating in a global delusion. If the only way to protect your sovereignty is to buy into a system that relies entirely on new entrants paying higher prices to sustain the reflexive flywheel of corporate debt, you haven't fixed the economy, you've just gamified it.
Look, let's summarize where we are, because we are looking at the exact same data and coming to completely different conclusions.
Fair enough, I'll go first.
Go for it.
My position is this. I will give Bitcoin credit for being a fascinating technological artifact. It has survived everything thrown at it. But the financial structure being built around it in 2026, this whole strategy of digital credit, amplified returns, and corporate treasuries taking on massive debt to hoard it, is highly dangerous. It is a perpetual growth machine being operated in a cyclical world. History tells us that trees do not grow to the sky. When the reflexive flywheel unwinds and the hype cools off, we are going to realize we took a speculative asset with a D- in economics and made it a systematic risk. It's a house of cards.
And my summary is that you are looking at the invention of the wheel and complaining about the road noise. Bitcoin is the escape hatch. It is the only ethical network in the world because it is mathematically immutable and open to everyone, whether you are a Wall Street firm or a teenager in Japan. Ray Dalio is right. Empires fail when they debase their money. For the first time in human history, we have a counterstrike. We have absolute digital property. The evolution of companies like Strategy and products like STRC aren't bugs. They are the features that finally allow the world to monetize this energy efficiently. We are upgrading the global operating system to a truth-based economy.
Well, it is certainly going to be a wild ride either way. And ultimately, you, the listener, have to decide if this is a digital illusion or the bedrock of the future. As we mentioned at the top, none of what we have discussed today is financial advice.
Absolutely. Do your own research, understand the risks, and pay attention to what the smartest people in the room are actually doing with their capital. If you like this talk and want to stay ahead of the curve, please subscribe and like this channel. We will see you next time on The Debate.